ICICI Prudential AMC. Rahul, good afternoon. Thank you for joining us. Rahul, what looked like the liquidity scare on Friday same time, today I guess the panic in the equity market has not got completely weeded out, but the bond market is trading as if nothing happened on Friday, and there was no scare which was created by a fellow fund manager who was forced to liquidate Dewan Housing paper at 11%.
Yeah, thanks, Nikuj. See, at ICICI Prudential, we typically follow strategy which is safety, liquidity, and return. And first and foremost, priority for us is the safety, and then comes liquidity, and then comes return. So, safety and liquidity are of utmost importance to us, and that has enabled us to, tide over all the short-term unnecessary volatility and temptations as well. So, on the bond market, you said, so I think GSEC market yields are up about say 2.5 to 3 basis points. That is by and large in line with basically the way currency has also, INR has also gone up to 72.50 to 72.55. So I don't think that bond market is in a challenging situation. We think that bond markets are likely to be in range bound, and people would be watching RBI monetary policy, which is due on 5th of October. That's going to be a big event from here.
And there is going to be a year-end compulsion which would be at play. When I say year-end compulsion, I meant by quarter-end compulsion which would be at play because it is September end. And then if Reserve Bank of India increases rates by 25 bips or 50 bips, that could be additional liquidity pressure. So if not today, but can I say next 15 days, there would be a liquidity crunch?
See, as we measure, the core liquidity is anyways in deficit about say 60 to 70,000 crores, and market borrowing from the Reserve Bank have been net borrowing of around say 130,000 crores. I don't think liquidity is going to deteriorate further from here. But yeah, at the margin, at the overnight rates, if RBI hikes in the next policy by 25 basis points or so, then at the marginal rate, the cost of money is obviously likely to go up. And that I think to a great extent market is already pricing in, like say we are seeing 3-month T-bill is already trading at 705, 710 levels. So that's about say 55 to 60 basis points away from the repo rate. So market is anyways discounting probability of 25 basis points hike, if not more.
Rahul, so what is it that you are investing or rather advising your clients to do? You think short-term duration funds like liquid funds is the go-to option in this kind of a market scenario?
Yeah, so the macro that we follow and the models that we follow is typically advising good amount of caution and carefulness to be observed in the investments at this point of time. With oil at close to $80 a barrel, and US Fed also hiking rates, along with quantitative tightening continuing in US, and other developed economies like say UK or Eurozone also expected to hike rates over a period of time. We think that it definitely warrants caution for fixed income investors to remain to exercise caution and remain invested in the shorter end of the curve. And very little compulsion or very little interest for us to increase the duration risk in the portfolio at this point of time.
So Rahul, now for someone who, let's say, is of the view that I want to go back to debt market, equity is too dangerous, I don't want to expose too much of risk to equity as an asset class because of high crude prices and because of elections next year. Is buying debt a good idea at a time when the interest rate curve is on the upside? Because if interest rates they keep on going higher, that also will not be a very happy scenario for a debt investor.
Yeah, you're right. So what is happening is, if you see how the curve is pricing in the probability of rate hikes over a period of time, what we see is that the shorter end of the curve is very, very lucratively priced, and the risk-adjusted return on the shorter and medium duration of the curve is definitely warranting good investment opportunity. And that's why we are saying that debt funds still offer a great opportunity as long as investors are participating in the shorter end of the curve. And we are definitely not advocating any investment or any incremental money to be invested in the medium or longer maturity funds. What we are saying is invest in conservatively managed and shorter maturity of the funds, and there we think that the risk is adequately priced in, and the returns expected to be reasonable over a period of time.
Rahul, great having you on the show. Thanks so much for that sound piece of advice from you. Really needed that, kind of prudent advice for all those wary and extremely jittery investors on there.